This is a FarmDoc Daily webinar. I'm University of Illinois Extension's Todd Gleason, your host for our program today. This one's entitled Farm Profitability and Risk Going into 2022. It's a four-part series. If you're here today, you'll be signed up for the other three. They're upcoming on Thursday, Tuesday, and Thursday of the following week and a half. Today, we'll take up crop insurance and risk management. Our topics will be economic outlook, crop insurance, and farmland rentals. We would like to also say thank you to our sponsors, including the TIA Center for Farmland Research, Compeer Financial, Corteva, Farm Credit Illinois, FS Growmark, the Illinois Corn Growers Association, and of course the Illinois Soybean Association. Let's begin with this quick little poll. So we'll go through a quick poll. What is your estimate of cash soybean prices this fall? You think they'll be over $14? Between $13.50 and $14? Between $13 and $13.50? $12.50 to $13? Or do you think that by the time we get to the fall, the price of soybeans will be less than $12.50? Go ahead, take some time and put your vote in at this point, and we'll give you an answer here about the time we get to 70% of you. And as we pick up through the first 10 minutes or so, we'll get a few more folks on, but there are about 135, 140 of you at this time. More than 70% of you have voted, and it looks like, classic bell curve sorts of things. And about a third of you think it'll be between $13 and $13.50. So 31% in that range. But if you just say between $13 and $14, that captures the bulk of the folks who are online with us today. Well, let's talk about that economic outlook just a bit. Gary Schnicke is here with us, agricultural economist from the University of Illinois, along with Krista Swanson, and she works with the FarmDoc team as well in agricultural economics. Thank you to both of you for being with us. I think, Krista, we'll start with you today. Thank you for being with us.
Yep. Thanks, Todd. Yeah, we're going to get started with the economic outlook for 2022. And I guess before we do that, I'll say that the soybean prices, I think that's maybe, I wonder if some of those answers are influenced by where the, current futures prices are for harvest right now. But that $13.50 is what we're currently using in our budgets, which we'll talk about in just a minute. But the economic outlook for 2022, it has its pain points, but it also has some bright spots. And we're going to start with what is probably one of the biggest concerns among grain farmers, and that's fertilizer prices. So fertilizer prices began moving higher throughout the mid part of 2021 and have really increased dramatically since then. The numbers shown here on the right side of this graph are from mid-January. And at that point, anhydrous ammonia had reached $1,486 a ton, which is nearly 3 times higher than the $500 price of just 1 year prior to that. And it's also a lot higher than the nearly $1,200 per ton price that was the previous high set back in 2008, which is shown on the left side of this graph. And in January, the prices for DAP and potash were, DAP was $853 a ton and potash was $806 a ton. And both of those are roughly double from their high a year ago, from their price point about a year ago. But those are still lower than the prices for those two fertilizers that we saw compared to 2008. So for anhydrous, we're seeing higher prices. The DAP and potash a lot higher than a year ago, but haven't cleared their 2008 record highs. When we think back to 2008, the price surge at that point was associated with some factors like strong domestic and global demand when fertilizer inventories were low. And the U.S. fertilizer industry struggled to adjust production levels. And as we think about what's coming into play with these increases now, it's the same factors, but we also have lingering impacts of COVID-19 and associated supply chain disruptions and geopolitical relations. And so we have other things coming into play that are, adding to the uncertainty in these markets. So when we think about how do we translate what we're seeing in fertilizer prices to the farm budget, and we want to jump ahead to the next slide here, how do fertilizer costs compare to 2021? So recommended application rates for each fertilizer are shown in this table for corn and soybeans. And for corn, farmers are likely to apply somewhere between 207 and 234 pounds per acre of anhydrous ammonia, 177 pounds per acre of DAP, and 88 pounds per acre of potash. For soybeans, the recommended rate is around 111 pounds per acre of DAP and 133 pounds per acre of potash. So in fall of 2020, when we were looking at prices for the 2021 crop, the prices per ton for each of those fertilizers are shown here, and then how that translates to a cost per acre given those application levels. We see that for 2021 crop, based on fall 2020 prices, we had total fertilizer costs of $94 per acre for corn. And then for soybeans, we had total fertilizer cost of $46 per acre. And then looking ahead, so using the price points from fall 2021 for the 2022 crop, and kind of using the same process here, using those prices per ton and translating that to cost per acre for each fertilizer, we have total fertilizer cost of $232 per acre. So you can see how much higher that is as compared to the cost for the 2021 crop. And then the same thing for soybeans, and we see that fertilizer costs for soybeans at $106 per acre for the 2022 crop are more than double than our fall 2020 prices for 2021. And then looking at what that means in terms of changes per acre, we see corn fertilizer costs increasing by $138 per acre, and soybean costs increasing by $60 per acre as compared to our 2021 crop costs. And so looking at what that means in the whole budget, these are the latest 2022 budgets that we have, which have been updated from those published in December, I believe is the most recent ones published. And so we're using yields per acre of 220 bushels per acre for corn and 70 bushels per acre for soybeans. Prices we're using right now for corn are $5.40 per bushel and soybeans at $13.50 per bushel, which, as I mentioned, is kind of right in that sweet spot of where we had the most responses on that poll. These prices are an increase from our last set of budgets, and they reflect what fall bids are showing right now. When we plug in our fertilizer prices, and we are using $230 per acre for corn and $102 per acre for soybeans currently. Those who applied their fall fertilizers or their fertilizers in the fall or priced it in the fall, they're going to have lower fertilizer costs. So this is going to be something that's variable from farm to farm. If you look at your own budget, depending on when fertilizer was priced and purchased, that's going to vary greatly. These prices here are more representative of spring applications coming in at those higher cost levels that we just talked about on the last two slides. And then individual line items for the rest of the direct costs are shown here, with bringing direct costs to a total of $512 per acre for corn and $270 per acre for soybeans. We also are showing power costs and overhead costs. Corn total non-land costs come in at $755 per acre and soybeans at $476 per acre. And so notably, non-land costs are higher for corn, which is expected. What we want to really focus on is this operator and land return figure. And for corn, we have $433, which is that gross revenue minus our non-land costs. And for soybeans, that's $469 per acre. So the soybeans are projected to be more profitable currently. And I just wanted to note that this is a changeover from our earlier projections. And the main reason for that is since the December budgets, as an example, corn prices are higher and soybean prices are also higher. But using harvest future prices as our gauge for how we set prices in these budgets, soybeans have increased proportionally more than corn, enough more that it's pushing that corn minus soybean return to that -36, or saying it in a different way, soybeans being $36 more profitable than corn at this point, given what we know or estimating right now. And so in the circle over on the right side of this chart in the 2022 bars, we're showing where that operator and land return falls for corn and soybeans. And we can see that soybeans are higher. Soybeans have tended to be higher over the past decade, which was a change from the previous decade in which corn tended to be higher in most years. Another takeaway looking at this is that operator and land return is reflecting the amount of returns available to both the farmer and the land owner. And so if we assume a cash rent situation or look at what that means in a cash rent situation, our cash rent in our budgets is projected at $309 per acre for 2022, and that's the black line here. And you can see that our budgets are showing pretty good profitability levels for both corn and soybeans, which is a great thing going into this year. We think about the cost side of things. This shows our non-land costs in the maroon and the cash rent levels in teal since 2000. We see that the cost of putting corn in the ground for this year is the highest that it's been in that time, and cash rent is also the highest. We look at how this compares to 1 year ago. Our non-land costs for corn are $755 per acre as compared to $631 last year, and really kind of around that $600 range for the past several years. And cash rents have also jumped a little bit from what we've seen in recent years too, bringing our total cost on rented ground up to $1,064 for corn, which is edging out over that $1,000 mark. And the reason we evaluate those cost levels and why that's so important is because that's really important to know when you go to market your grain and thinking about what the break-even prices are. How do those cost levels translate in terms of break-even? And for this year, our break-even price point on is $4.84 for corn, given those current budgets. And I will note that $4.84 is based on total costs, including cash rent. So if you think about what we just looked at on that last slide, it's that last bar, including the cash rent. If we were to not include cash rent just for reference, that would be $3.43. Another thing shown here, so that blue line represents our total cost break even, again, including cash rent. That red line is another way of looking at it. And we've had a lot of years in recent times where we've had revenue from other sources like government payments and crop insurance coming into play. And when we look at what our costs are and take that other revenue out of there and look at what our break even was needed to cover what our break even was needed at our price for our production, you can see how much that lowers that when other revenues considered. This year, those two lines fall in the same spot in our projections because we aren't projecting any other revenue coming in. Similar thing with the cost of producing soybeans. Looking at this year, again, we have that $476 non-land cost paired with a $309 cash rental rate, bringing those total costs up to $785 on cash rented farmland compared to $651 last year. And if you consider non-land costs only, we're $99 higher for this year than last year. And what does that mean in terms of break even? We're at $11.21 on that total cost for break even with cash rent included. And without cash rent, that number is $6.80, just to throw that out there. And again, as with corn, we aren't expecting any other revenue sources coming into play here. So that break even is $11.21. And you can see that aside from, a peak year around 2012, that is the highest break even level we've had. The good news is that it's still below where prices are right now for the 2022 crop. So these are high break-even levels, but for both crops, the fortunate thing is that despite there being high break-even levels, we do have prices. We are able to market at a profitable point at this point. So with that, I want to turn over to Gary. He'll be using what this means in terms of crop insurance and why that's important this year.
Yeah. Thank you, Krista. And now we're going to turn to protecting that revenue as best we can with crop insurance. And I have a question for you right now. Are you considering the enhanced coverage option, ECO, this year? So give me an answer here. Are you thinking about it? So this was a new policy that was available last year. Actually, quite a few of you took it, at least for a new option. 7% of the acres were insured last year. We're going to spend most of our time talking about that option relative to a straight RP option. So we're going to go through some of the RP options that you have, and those are all related to coverage levels. And then if you're concerned about those risk levels under the basic RP policy, we will talk about ECO and SCO as alternatives. So we're going to close the poll now here, Jim, and here's what you are saying. We got half of you saying no way, and yes, maybe is 35%, and yes, strongly is 11%. So those are our breakdowns now, and so let's go through crop insurance. We have, again, till March 15th to make our decision. If you do nothing, you will get the same policy as you did last year. It's a continuation policy. Here we are looking at the different 6 types of major policies that exist. There's also margin protection, but you had to take that one in fall. So these are the 6 that you can choose between now. Most people are at RP, revenue protection, and so that's where we're going to spend most of our time talking about. And then there are the add-ons to that RP, and you could also have the add-ons to RP, HP, and YP, but again, most individuals are at RP, and we have SCO and ECO, which are add-ons. Again, most farmers or most acres insured in Illinois are at RP. 93% of the acres are at RP, with the 3% being YP and 2% at ARP. And if you look at that 93% of RP insured acres, a third and a third are at 85% and 80%, and then 15% is the next level. So we get the 3 highest coverage levels having the majority of the acres. And if we look at this state, northern and central Illinois predominate in 85 and 80% policies, and southern Illinois goes 80 to 75 to sometimes lower. And those are mainly related to premium cost. Again, 3% of our acres are insured in margin protection, and last year 11% of the acres had supplemental coverage option. That has been growing a bit over time, and 7% of the acres had enhanced coverage options. So ECO and SCO, 11 and 7% respectively. So if we look at what farmers have done, the preferred crop insurance policy of most farmers are RP with trend adjustment. Most individuals take the trend adjustment, increases the guarantee yield. And if yield exclusion, and there are some exclusions, some counties where yield exclusion is available, use it. And most farmers take that at a high coverage level. And again, if you're looking at northern and central Illinois, those are 80 and 85%, and southern Illinois, 75%. I would note, if you're starting out with a recommendation, if that's where you're at, staying there is probably a good idea. So if you took 80 and 85% last year, think about that again for this year. That will be a good policy, and perhaps add on to that SCO and ECO. Again, sticking with that high RP, and we'll show you why here in a minute, but RP at a high coverage levels with those options will provide you decent risk protection. It is going to come at a higher premium cost. So we are not done setting projected prices for either corn or soybeans. That will be done by the end of the month. We are already end of February, so we're roughly over halfway, somewhere there. But if we're looking at it right now, that projected price for corn would be $570-ish, maybe shading a little bit higher. That compares to $458 for last year. So we're going to have much higher projected price this year, which will result in much higher guarantees. And those guarantees are needed, as Krista showed. We're looking at much higher non-land costs from the previous year. So we're seeing costs go up $100 per acre. In some senses, that higher projected price makes up for those cost increases, so we can still be insuring it at sort of a break-even level, and we'll show that here in a minute. I'm going to give you, just to show you the impacts of crop insurance, we're going to go through a corn example, and we're going to do this for one county, McLean County. We've done this for a number of counties, and if you want to read more about this, you can look at the FarmDoc Daily, which will be linked in the video description when we put this up. But this farm has a 220 bushel APH yield, trend adjusted APH yield. We are going to use a 570 projected price, which is where it's at currently, and a 0.23 volatility. By the way, we're fairly confident that we're going to have, projected prices in that higher range, unless something falls out of the market here, but that's difficult to see at this point in time in February. Our volatility, we're using 0.23. That's exactly the same as last year. That volatility will be set the last 5 days of trading. So that could vary from that, and that volatility will have a big impact on premiums. I'm going to show some simulation model results of different policies for 2022. And we're just looking at different possibilities in giving a feel for the chance of lower revenue without insurance, and then under 2 RP policies, and then adding ECO and SCO to it. When we're looking at that, one of the things that we have to keep in mind is that we are going to be paying much higher premiums this year. This is a 220 APH. The bluish, the column shows those premiums in 2021. So an 85% RP policy last year cost $24. This year, given a 570 projected price and a 0.23 volatility, the same as last year, we're looking at a $30.33 premium. So premiums are going to go up this year. The reason they are going up is because of the higher projected price. Now, that $30 again will vary depending on that projected price and what it finally is, and very consequentially on the volatility. So we're using the same volatility as last year. That could differ. Again, we've seen volatile markets, and we'll see what it looks like the last 5 days of this month. But 0.23 is where the volatility is at currently in this market. Again, you're looking at $6 higher premiums for 85%, $3 higher for 80%. And that may have some individuals thinking about lowering coverage levels. Again, all costs are going up this year, including crop insurance. So let's look at what RP does by itself, and I'm going to show results here for RP 80% coverage level and RP 85% coverage level, and also no insurance. So let's just go through this. Farmer paid premium. Zero premium for no insurance, $14 for RP 80, and RP 85% has $30 of premium per acre. Again, that's what the farmer paid premium would be. If we're looking at the expected revenue, we have $1,174 for no insurance. And again, that would be price times yield. And we're looking at a wide variety of yields and prices that could happen in 22. And those are weighted based on what has happened historically to price and yield changes. 1174, and again, as Krista mentioned, we have 1060 in cost, roughly 1060 in cost. 1174, we are expecting a profitable year. If we look at adding RP 80%, that expected revenue goes up from 1174 to 1190. The reason why it goes up is because federal crop insurance is subsidized, and the subsidy causes payments from the expected payments or payments over time to average more than the premium cost, and that is by design. Having said that, most of those premiums come in specific years like 2012. So there's a number of years when those payments won't be made, and then other years in which there will be large payments. Whether this year is a large payment year, no one knows at this point in time. But overall, we would expect expected revenue to go up with RP 80% and RP 85% to go up as well. We would expect our RP 80 and RP 85 will put a minimum revenue in place. That's $773 for RP 80. RP 85% has $829. So that minimum revenue, and again, that minimum revenue occurs because RP sets a guarantee that has a minimum revenue in it. There is no minimum revenue for no insurance. So it does put those minimum revenues guarantee in place. I would note that both of those are below our 1060 expected cost. If we look at cost, there is, if you put crop insurance in place, and we look at a revenue of 1050, and 1050 is sort of our cost level, we have a 33% chance of being below that with no insurance. So 1 in 3 years, we will think that we'll be below that 1050 cost level, or we will have losses this year. 1 in 3. RP 80 and RP 85 don't do much to the probability of being just below 1050 because their guarantees are lower than that. However, if we look at 950, without insurance, we have a 19% chance of 1 in 5 year. That goes down to 12% with RP 80 and 6% with RP 85. And then for 850, we don't have those probabilities, or those probabilities go way down with RP 80 and RP 85. So RP 80 and RP 85 will lower our chances of revenue. And in actuality, they increase our chances of expected revenue as well. $14 is the premium cost. We don't have any crop insurance payment. Obviously, taking a RP 80% policy will lower lower returns $14, and RP 85% will lower $30. Summary here, RP 80 and RP 85 will provide effective coverage. RP 85 has higher expected returns, and so does RP 80. This is because crop insurance is subsidized. And really, the only reason not to do the RP 85% is because of the higher premium. So if you're concerned about the higher premium, RP 80 will provide you protection, but the protection, and obviously RP 85 will provide more protection. So those are RP and 80 and 85%. Now let's look at the supplemental coverage option. And again, this is county coverage. It goes from 86% to the coverage level of RP per policy. You can only use this if you selected price loss coverage, and it's eligible for RP or the combo products. It will mimic the underlying coverage of the RP policy. If you had selected RP, HB, or YP, it would mimic that coverage. Enhanced coverage option is the one that was available last year, and it allows you to take from 90 to 86%. You don't have to use SCO with that, but you know, many people think about it, but if you take it, you can take from 90%, for example, down to the coverage level of the underlying RP policy. Again, it's a ECO, unlike SCO, is available no matter the commodity title choice, and it again mimics the coverage of the underlying RP, HP, or YP product. If I were taking ECO and SCO, I would think about them as two separate policies. In other words, don't think about don't think about it as I have coverage from 90% down, but I have county coverage from 90% to 80% and farm coverage from 80% to 0%. That example, the second bullet point here is you took RP 80%, you took SCO, a bundle, 86% to 80%, and ECO 90% to 86%. Again, you got county coverage from 90% to 80%, and that differs from farm coverage, which you have from 80% to 0%. And just a reminder, county coverage is good for general economics. Again, it does not provide farm level coverage. So a farm could have a poor yield, for example, and the county would not. And one other point here is ECO and SCO do not include prevent plant payments. So let's take a look. So we got that RP 85% policy. Let's add a SCO policy to that. That SCO policy for 85% only goes from 86 to 85%. So its premium is $189. So the premium goes from $30 to $32 per acre. Everything we do now is going to add to the premium. Expected revenue does go up, and it doesn't go up because of the subsidy effect. There's very little impact on the minimum revenue, and slight changes in chances of revenue below 1050, 950. Just minor reductions. Again, that happens because there's SCO is only providing a percent coverage, 86% coverage level to 85%. All right, now let's add to that ECO 90%. All right, so we've had RP 85, RP 85 plus SCO, RP 85 SCO plus ECO. ECO premium is $14.96, so we go from a $32 premium up to $46. That happens to be the highest protection level. You can change the protection level and lower it. You'll lower the premium, and you'll also lower the payments when they happen. So if you lower the protection level, what you're going to do is lower the premium, so it would be less than $46 total per acre, but you would also be reducing some of the risk benefits. Again, expected revenue increases because of the subsidy effect. There's a slight increase in minimum revenue, but you do really decrease the chance of having revenue below 1050. That goes from 31% to 20%. So there is a good possibility of lowering that revenue, chance of low revenue, 1050, or not being covering costs from 1 and 3 years to 1 and 5 years. All right, that is ECO and SCO 90%. Now let's do it at the high coverage level. Here the premium is $40. So you're having a $72 premium. By the way, at this point in time, you know, if you look at our expected revenue minus non-land costs, it's over $100, but you're taking $72 away from that premium in a normal year. You do increase expected revenue, and again, it increases because of the subsidy impact. It has a little impact on minimum revenue, and it does reduce the chance of having revenue below 1050. A little bit over the 90% coverage level. So you see there the impacts that can happen, and ECL, particularly at the 90%, will reduce chances of low revenues. We put in here, and I'm not going to talk much about this. This does the same thing, RP 85, and then you want to lower RP 80 from the RP coverage level from 85 to 80 and add SCO and ECL to that. You see the results there. You can get close with those combinations of SCO and ECO 90% to having the same probability of 1050. You can actually get below it with that RP 80% coverage level and the ECO 90%, and only have $38 of premium rather than the more costly 85% coverage level. In any case, if you have no insurance, the chance of reaching your minimum revenue goal is 67%. Let's say you want to get 1050 in revenue, it's 67% with no insurance. RP 80 doesn't do a lot. RP 85 doesn't do a lot to that, but it does lower the probability of being below 950 or meeting the 950 and 850. You add ECOs to that, you can increase those quite a bit, and that'll just give you a feel for it. So if we're coming to a summary here on ECL, you're going to have very high premiums because the payout often occurs. It will increase expected revenue, but it will significantly reduce returns in a normal year when you don't get crop insurance. And we'll have some downside risk protection, and it really does depend on how much you want to pay in premium. And do you want to pay $60 in per acre premium in a normal year? Soybeans are going to be much the same example. We find the same results for soybeans as for corn. Currently, the projected price for soybeans is close to $13.80, so that'll give you a feel for where we're at. And just to summarize crop insurance, if you were at a high coverage level RP last year, we would suggest staying there. And you have much higher cost and much higher risk, and the projected prices this year are going to offer reasonably good protection against that. And if you want more than RP 80 or 85% in northern and central Illinois and RP 75% in southern Illinois, 75 and 80%, think about ECO and SCO. So we just got one question here. So what are you thinking about what will happen to corn acres this year? We're seeing, obviously, these cost increases. So what are we thinking is going to happen here before we just end this discussion with a discussion of rental arrangements and what they're going to impact here? We won't know this officially until the planning intentions report, which is end of March. So we got a ways to go yet. And we'll get our first inclination here today. So,
In fact, we'll get our first inclination here today that the USDA will take that survey with farmers. That March survey, by the way, is interesting, Gary, because it is an actual survey of farmers. So USDA is making a projection based off what farmers say. Just one quick thing too: if you've got questions for Gary, do put them in the end. For Krista, do put your questions in that question box as well. So Gary, it looks like most people think corn acres are going to decrease, I guess. And I don't know. What do you think of that answer?
I'm a little surprised that it's as high as it is, but I don't know. The soybean prices have actually been rebounding very nicely here recently. So we will take us through to farmland rental, Krista.
I'll take it over here with farmland rental. So we think about lease types. There are different variations on rental agreement types, but we think about three main types of farmland leases that we talk about. Traditional cash rents, in which the farmer tenant would pay a flat fee to farm the land. A traditional share rent, and there are variations on the splits and these types of agreements, but a kind of a traditional one would be a 50-50 agreement in which the direct costs are split between a farmer tenant and a landowner, and then the production is shared evenly between the two parties as well. And then a variable cash rent. And again, there are many different ways to structure a variable cash rent agreement. But often this type of agreement would involve the farmer tenant paying the landowner a base cash payment up front that would be set at a rate that was lower than what a traditional cash rent would be. And then there would be some sort of rent factor for calculating a bonus payment after the crop is produced and yields and prices are known. And so at this point, most 2022 lease agreements are already established, but I'm going to share a little bit about an evaluation of farmer and landowner returns under these alternative rental agreement types. So earlier at the beginning of the webinar, we went over our current budget projections for 2022. And in those, we're using just a single price point at $5.40 per bushel for corn and $13.50 per bushel for soybeans. But here we take a look at what returns would be under different price scenarios, with everything else from those budgets staying the same. And especially because we're considering some low price scenarios, we're accounting for crop insurance indemnity payments as part of revenue when applicable. So as we think about our revenue calculation, we first think about price levels. And so we have what fall 2022 harvest price could be based on what we're saying would be a futures price at harvest. And of course, we have talked about where that is now, but we show here 5 different possible scenarios. And that is different from your cash price that the farmer would actually receive because of basis, depending on the region and market outlooks, or market outlets, excuse me. But here we show estimated cash prices that are 30 cents lower than harvest price to account for basis. And then we take this cash price times our 220 bushel yield from the budget to calculate crop revenue under each of these price scenarios. And we see that crop revenue ranges from $792 per acre to $1,320 per acre under these scenarios. And then again, revenue protection is our crop insurance. In this example, we have revenue protection at an 85% coverage level because that's the most common type and coverage level used in Illinois. And revenue protection at the 85% coverage level does make payments when harvest prices get low enough. With these 5 examples shown here, we start triggering a payment at $4.50 and lower. And so basically RP begins to offset declines in our crop revenue. And in this particular example, it puts a floor on gross revenue at $1,000 an acre. And so to calculate our operator and land return, which we talked about when we were talking about the budgets, we take these different gross revenues and subtract off the $755 per acre non-land costs that we talked about earlier. And so these price scenarios result in operator and land returns that range anywhere from $245 per acre to $565 per acre. And I just want to note here that there are situations which could result in lower operator and land returns besides those shown here. Like, for example, if we had higher non-land costs than that 755 that we're using. But for the purposes of this example, this is kind of the range that we're presenting here. So operator and land return, again, represents this total return to be shared between the farmer and the landowner. So when the land is owned by the farmer, 100% of that's retained by the farmer, but on leased land, this would be split according to the lease agreement. So first, looking at what this means for landowner returns. In a share rent situation, landowner returns range anywhere from $244 an acre to $404 per acre. In the cash rent situation, the landowner returns are $310, regardless of price or return scenario. And in a variable rent situation, landowner returns range from $253 per acre to $422. I want to make a few comments on what we're seeing here. Share rent landowners have lower revenue at those lower price levels because they're sharing in the production risk, but they also are sharing in on the return side. So as we see price at those higher scenario levels, share rent returns increase to higher levels than a flat rental rate. At the lower price level, cash rent landowners fare the best because their rate's not dependent on the lower returns. And variable cash landowners have lower returns than a flat cash rent at lower price levels, but they have higher returns than share rent owners because at the high price levels, because they're not sharing in production risk like the share rent landowners. And looking at what it means for returns for farmers here, in a share rent situation, farmer returns range from $1 to $161 per acre. And in a cash rent situation, we see farmer returns ranging from a loss of $65 per acre up to $255 per acre profits. And in a variable rent situation, we see farmer returns ranging from negative $9 per acre to $143. And a couple comments on what we're seeing here. So at the low price levels, the farmer is right at break even in the share rent scenario, which doesn't seem like a great position to be in from a profitability standpoint. But when you compare it to the other rental agreements that are resulting in a loss at those low prices, the share rent is actually the most favorable to farmers in this year if we would have very low prices. For a farmer, that flat cash rent results in the lowest returns at low prices, but the highest returns at higher prices. And we also have a slide for soybeans, and in the interest of time, and so that we have some time for questions, I'm not going to talk through that near as thoroughly, but I'll make the point that kind of you can draw the same conclusions about the divide of operator and land return between payments to landowners and payments to the return to landowners and return to farmers in those situations for soybeans under a number of different price scenarios as well. And I also want to mention that if this is something that's interesting to you and you want to learn more, our February 8th FarmDoc Daily article covered this and also had quite a few more price scenarios in the tables presented in that article. So that's a really great resource if you want to dig into this deeper. Kind of as a summary on farmland leasing. So a few takeaways here. If price is greater than is greater than or equal to the current price levels that we're using in our budgets, and yield is greater than or equal to those trend yields that we're using in the budgets, then farmers and landowners are both going to be profitable this year. If we have a decline in returns that could be due to price and or yields, then farmers will experience lower returns regardless of lease type. At that $310 cash rent level, returns can be negative for corn and low for soybeans, even with RP 85%, which we've talked about that some in this webinar too. And that's just because our costs are high this year. And then landowner impact, returns would be lower for landowners with share and variable rents, and unchanged for those with fixed rents. Another thing I want to talk about is those tables that we were just looking at used rent factors of 32% for corn and 43% of soybeans. And what that means is those bonus payments on variable leases would be based on 32% of gross revenue for corn and 43% of gross for soybeans. And those were calculated last year at rates that resulted in making variable rents equal to fixed cash rents for the years from 2000 to 2020. When we think about the costs in those years as compared to what we're seeing this year, things look quite a bit different. And so that's why we're seeing that what we looked at on the last slide in terms of those variable returns for farmers and landowners. So if rent factor adjustments are made, then higher non-land costs would suggest lowering those rent factors for this year to account for those higher cost levels that farmers are experiencing. And then kind of a general summary side for the whole webinar. 2022, it looks to be a profitable year, which is great news, but it does have some risks. RP at high coverage levels will reduce risk, help mitigate risk for farmers, and ECO can provide additional risk protection, but it does come with a really high premium cost. And then 10-year relationships matter. May need to consider lowering some rent factors on variable cash rent agreements, given those high cost levels this year. And with that, we'd like to thank everyone for listening to the webinar today. Todd, I'll turn it back over to you.
Indeed. Thank you, Kristen, and thanks to Gary as well. If you have questions for them, put them in the box and we'll get them answered here momentarily. We would like to take a moment to thank our educational partners. They include the College of ACES, that's the College of Agricultural, Consumer, and Environmental Sciences, University of Illinois Extension, and of course, the Department of Agricultural and Consumer Economics, along with our sponsors, the TIA Center for Farmland Research, Compeer Financial, Corteva AgriScience, Farm Credit Illinois, FS Growmark, the Illinois Corn Growers, and the Illinois Soybean Association as well. We'll get to a couple of quick questions. I think there are some. Can you start me out with what you think is of interest, Gary?
Yeah, so we will start with this question. Can you comment on RP 85 HPE, which is the harvest price exclusion? So potential risk and premium savings. So we have been talking about RP, and that was what all the demonstrations were for during this article. RP with a harvest price exclusion does not have the guarantee increase in it. So the guarantee will not increase. That comes at considerable premium savings. And to give you an example, that $30 premium saving that we were talking about for RP 85% would be roughly $15 with RP HPE. So you can roughly cut at those high coverage levels, those RP premiums down quite a bit. If you want to see what those premiums are, you can either go to our online web tool, or we have a downloadable spreadsheet, crop insurance decision tool that looks at both of those. Here are the risks to RP HPE. Is you will be sad during a drought year if you take RP HPE. And what happens in 2012 would be the classic example. And actually, I'll give you an example of what I think a 2012 drought would do in 2022. That's 10 years ago now. Time flies when you're having fun. So in 2022, we have a 570 projected price, which is pretty close to what it was back in 2012. If we have a major drought in Illinois, the harvest price will go up, and it would probably go up to something like $7.50 an acre, or excuse me, per bushel, to $8 per bushel. Then that increase under RP-HPE will offset many of the payments. So drought years 2012, RP-HPE will have much lower payments than RP. That's fine, just as long as you're aware of that risk. RP-HPE actually does a reasonably good job, or does as good a job actually as RP at reducing downside risk. The other side that I would say, if you're taking RP-HPE, you do not want to be aggressive pre-market hedging the crop. So if you're thinking about doing 50% more of expected production before harvest, I'm going to hedge 50% of my expected production or more. I would say stick with RP. If you're going RP, if you're not going to do that much, think about RP-HPE. So there is another question. What is the future of input costs, nitrogen in particular? So we can put on, here's what I would say about input costs. Do not expect any reduction in input costs before planting in spring. Anhydrous ammonia and other nitrogen sources may come down some, but when we're talking about some, we're talking going from high $1,500 or close to $1,500 for anhydrous ammonia, maybe to $1,300, which is obviously worth waiting for, but we're not going to be looking at low cost. We still have those supply issues and concerns about pesticides in particular, and whether those will be available. So, Todd, you had a question, actually.
Well, it was related to those pesticides. As we know, weed control is one of the largest yield robbers that is available, though most haven't had to deal with that for a very long time because weed control has been so good. Is there a way, if you're concerned that you're not going to be able to control weeds because of availability of pesticides, to use crop insurance to try to mitigate those yield losses? And what should you use?
So if you were still thinking about not having all of your chemical, you would want to be taking either, so you could do that with a yield insurance or a revenue insurance. I would still suggest that you would want to take a revenue insurance, and you probably should not be altering much your insurance policy. Pesticides, so I would, if anything, keep my coverage levels at last year's levels or raise those. Pesticide inavailability is actually somewhat of an interesting question because it's not a natural result. So, but it will most likely be covered by crop insurance, and I would put a 99% probability of that. But it really isn't a natural result that pesticide unavailability causes your yield reductions are caused by pesticide inavailability. If that makes sense.
It does. With that, I think we can wrap it up for the day. Krista, Gary, thank you for being with us. I appreciate that. Thanks to everybody who's been online with us. Thanks to Jim Baltz, who is behind the scenes. Don't forget that you can find this webinar up on the FarmDoc Daily website. Just look for it under the archive at webinars, or you can look for it in our YouTube channel at youtube.com/FarmDoc video. And of Of course, as you leave today, don't forget to fill out that survey. We will take a look at them later this afternoon. We do thank you for being with us. It's the top of the hour, 12 o'clock Central Time. I'm Todd Gleason.